Hi everyone, this is Rohit Srivastava, the founder of Strike Money and Indiacharts. Now, if you don't know what is Indiacharts, just download the Indiacharts app. That's where I write my daily content. If you've heard me talk about everything from the Nifty to global macro, the short-term updates are there. And then I write the long-short report, 5,000 word document with 30 plus charts trying to explain the big picture scenario across equities, commodities, currencies, and link them all together. What do they all mean as a whole set? And that really gives you perspective in understanding where we are and why do we think what is going on and what is likely to happen in the months and years to come. So that's really important for long-term investors to get a judgment of. And that is why I really suggest, reading the long-short report and then really staying up to date with the daily updates. That's sort of how we go about at the Indiacharts app and website. But Strike Money, that is the most interesting tool for anybody who's not tried it out. Web.strike.money. When you see it, you know you have reached a different place. And then, of course, you need to try out all the tools. And if you don't get it, attend our weekend webinars that explain it to you or watch the videos over there. The point is, Strike gives you all the market data and analytics in one place. But not only that, it allows you to do that analysis, know where the market is topping, bottoming, is everybody bullish, is everybody bearish, what stocks to buy, scan, filter, search at the click of a few buttons, nothing complicated, no programming required, simplified like nowhere else on the internet or on any other financial tech platform. So that is what we've done. We've brought it all to you, and so that's the other thing that you should try out. So that's what I do, but what I really love is investing and trading in markets and communicating that, because that really helps. When you're a communicator and you're communicating your opinions to people every day, it polishes you, it keeps you on your toes and forces you to be on the right side, because of course being wrong is not funny, and the trolls will make sure, even if I didn't have trolls, if I have people who pay you to read and know your opinion, you feel responsible, right? So that responsibility helps you do your best. But in the end, what I intend to do is invest and trade for myself. And so that with that right purpose, I don't have any other vested interest in really sharing these opinions and views than having a community of people who understand what I'm really doing. And that is how I work. So what I say is what I do. What I do is what I communicate. That's how it works. We don't run any advisory service. I have no intention of being on any portfolio management service. And I do think that I'm the best manager for my own funds, and that is how it should be for everybody. And so I try to push people to not look forward to spoon feeding. Sure, I'm giving you my views and opinions, but the moment it comes down to spoon feeding, what to do, how to do it, how to execute, then that's something we can only teach you. I will not really do it, because that's where it's not just the regulatory part, but I think if you want to get the best results for yourself, you have to take the onus for your investments. So that's just my thought. Depending on others has not worked for most people. Sure, if you feel that level of dependency, then there are lots of PMSs and EMCs out there, and you can surely look at them. Some of them are good, I'm not denying that, but it's just my approach is to be a self-investor. So I don't really do mutual funds or PMSs as of now. I don't have any investments in such products. So having told you a little bit about me and how I fly, how I run, and what makes me go, let me get down to going, which is sharing what has really happened over the last several days, weeks, and where does it bring us in the overall market scenario. Very interesting point to be in, because on Monday I actually tweeted, I said maybe it's time for panic buying. Surely most people don't understand what that means. In hindsight, when markets have always recovered from every panic low, like the one on election day, people will say, I said so, you should have bought, etc. But if you spoke to anybody on election day, you would have only heard panic from every fund manager. You can see them on television. I don't know many people who came out and said this is an opportunity to buy. I probably did. My videos are online, so I'm not really faking it. But people were in panic mode, time for risk off, not to be in the markets. But what we really look at, and a lot of it is on sentiment, and sentiment indicators are now on strike for you to see. And on that day, you had a max short position. You had my short-term swing indicators also hitting single digits, which is 3% when it was down 1300 points. And that kind of an extreme situation is what you buy into, right? When there's blood on the streets, it's easy to say, when there's blood on the streets, buy blah, blah, blah. But when it comes to real time, can you really get yourself to do it? And that is the test of reality. And in that real situation, most people back off and they're not able to handle it. They don't know whether there'll be more panic on the next day. And bringing logic to head, like the simple thing that, well, you're not getting a new mixed coalition which could be weak, but an existing one which was already in power with fewer seats can't be all that bad. It's as simple as that. And that's what got the market going. So now we look at the last 1 week's action. A lot has happened, and some similar things, some different things. Surely you don't have an FII short position. They are more long than short right now. And they did buy into the post-election rally, but have been selling more recently. But what we have is more of a global setup where global markets have gone out of whack. And they've gone out of whack initially post-Fed. The Fed made it clear that the US Fed was ready to start cutting rates at some point of time, mostly by the September meet, something that's been on the cards for several months now. And they were just looking for some more continuity of the same data points, which means they already had the data points, but they just didn't want to pull the trigger yet. And then on the following day, you end up getting these ISM data which tells you that, unemployment might actually be ticking up. New jobs are not really showing up at the same pace. And new jobs have been slowing down for several months. I already tweeted that chart, so you can actually look at it. If you look at the, non-farm payrolls reports, you will actually find that, the payroll reports have been showing fewer and fewer hirings on a 2-year basis with small spikes in between. And so that was the trend. It's not that nothing new happened. And if you think that the Fed didn't know one day before the event that, this is the data that's going to come out the next day and took their call on rates, then also that would be foolhardy. So what really followed is a panic sell-off on Friday, driven by Japan. So that was really the twist in the tail, I think. It was not the US, but it was Japan that suddenly sold off, in double digits for 2 consecutive days and got the whole world to panic. Now, it's not that Japan was not already falling. It had been falling for a while, ever since the Japanese central bank raised rates by 0.25% from 0 to 0.25. I mean, that's still near zero, but that small little move, created panic around what is known as the yen carry trade. Now, a couple of weeks back when I was looking for the yen to, strengthen, because it's been my view that the dollar index is in a bear market. But the dollar index itself had not been falling very, very fast at the speed that I would really like. And one of the reasons was the yen had been weakening. So even though the DXY peaked more than a year ago, it's been in this sideways range, and you've seen weakness in the USD JPY going up, meaning weakness in the yen. And I thought that probably the last thing, because the Bank of Japan had already intervened a couple of times, the last thing that you probably needed out here was the Bank of Japan starting to raise rates. And I've been looking at the the Japanese bond market, and I've already published a couple of articles at Indiacharts showing that bond yields in Japan were going to go up, even though I've been looking for lower bond yields in India, in US, in Germany, and everywhere else. That's just what the charts were showing. So I was pretty much sure that they are going to raise rates, and that would finally stop the Japanese yen from weakening too much, because that's also a concern. Even though weakening the yen was one of the base cases that they had made more than 10 years ago for getting the Japanese market to take off, to start moving. And that has pretty much worked out, because over this 10-year period, the Japanese market has entered a bull market. It had its initial rally, first wave, I would say, into 2018-19, and then it had a second wave correction till the end of COVID, and started a third wave, which is still not over in that sense. So this correction, therefore, from a long-term wave point of view, would only be a pullback in Japan in the larger scheme of things. But in the very, very short term, because a lot of people do borrow in those cheap yens when interest rates are zero and negative, surely it's the most attractive thing to do, especially if the currency is also weakening, which means you have a double hedge. People who probably borrowed 2-3 years ago, just imagine that the amount of money they would have made in US stocks or Indian stocks. Would this small amount of move really hurt them? The answer is probably no. But what happens is borrowing is always incremental. There are a lot of people who would have taken fresh funds in the last 1 year also, and they end up hitting their margins. They end up, with a VAR report in front of them saying that, boss, value at risk is so much, this is your position, this is your mark to market, you need to pay up. And these positions are, they blow up pretty quickly. Moment you have a VAR report like that at a hedge fund, you're supposed to square up that entire position or whatever is in excess, and it pretty much is like press the button and it's over. And that is what causes these kind of panics where, suddenly you have the Japanese market falling 10-12%, and then you have the S&P falling 3 to 6%, the futures also, and then everything else, So there was a time when falling dollar is good for Bitcoin, good for emerging markets, good for gold. But for these last 2 days, it was everything sell, right? So that's because that's the margin call. When you have a margin call, whatever you own, you have to sell to pay the margin. And that's sort of what ends up happening, and which is why you get equities down, gold down, silver down, oil down. That's a scenario. And those are the people who probably borrowed much sooner, had a bigger position, and had to unwind it right now because they got a VAR report, right, saying that your position is in excess, or you can't hold on to this anymore. Those who have profitable positions, probably paying that small bit of interest is not really a big deal. So whatever unwinding had to happen is probably already happened in a knee-jerk reaction over the last 2 days. That's my main point. And the biggest signature of that is in the US market and the US VIX. When you see it spike all the way from 15, 20, go up to 65 in a single day and then close at 29, I don't think you've seen anything like that before. I mean, usually when you have a bear market, the VIX rises, it first goes to the 30 range, and then as the bear market continues, it goes into the 80 range, right? That is like in COVID or 2008. 20, but in between, when you had a bear market like 22, 1 year, the Nasdaq was down, we went into the 2030 range. So 2030 range was a range in which you did have a bearish trend. And so apart from the spike, so the VIX spike, the way it went to 65 shows capitulation, right? People just panicked, press the buttons, and you got a wild spike. But now you're at the 30 range. The question is, will you stay in the 2030 range in a broadly bearish market? Now, because this is a capitulation based on a yen carry trade unwind that's already taken place, because if you look at the USD JPY, the RSI at 11 is the lowest since 1985. And we've had many yen carry trade scares in the last 10, 15 years. Some of them which were not as spectacular as this one. And when people don't find any other reason why markets are falling and they see, oh, the yen is strengthening, they put it on the yen carry trade. So this was probably one that will be remembered and then be produced again and again as for future outcomes. But sometimes something doesn't just repeat in future again and again. So this case is over. So what next? So the only fear probably left in the minds of investors is going to be rotating back to the US recession story. Is the US going to go into a recession? So that keeps the pressure on, but the initial panic is probably over. Okay, and you have an extremely oversold USD JPY, which can't fall anymore in the short term. Probably will bounce back, retrace some of those losses, but the larger trend of the dollar has been set to the downside. So I don't think the DXY has stopped falling. It'll probably have a couple of more rounds. It may complete a 5-wave decline and then give you a bounce back, which means you may see one more low on the DXY on the downside, maybe below 102, and then from there you will see some kind of retracement. And once all that has happened, I think all the panic of, which is very unusual, because falling dollar resulting in falling everything is not something that you expect. What you expect, if there is a real risk off, is rising dollar and everything is selling off. Then I say it's a serious risk off, then it's a serious problem. But here you had, a falling dollar and falling bond yields. Very, very different scenario. But because it was a yen carry trade unwind at this point of time, the falling dollar did not really stimulate any buying. But if the yen selling is over, yen carry trade selling that is, then we can be in a different subset, right? Now from here on, a weaker dollar would actually be stimulative. And that's something to watch out for, because all this panic, what it has done, like I said, the carry trade sale is over. Now it's back to looking at the US recession story. And the weak data that we saw last week has at least managed to push bond yields down a lot and set the stage for a coming rate cut. In fact, people who are expecting 0 or 0.25, which means nothing, or maybe 25 basis points, are now saying 50 basis points and maybe 3-4 cuts in 2024. That's the kind of psychological change that has been made on the street. And for those who believe that the US Fed does follow the 2-year yield in terms of setting its rate decision, the 2-year yield also has come down sufficiently for the Fed to move. So the stage is set that the Fed is going to cut rates in September. unless they find some other reason for them to not do it. I mean, they themselves decide that, yeah, we have this other reason why we won't do it now. They've pretty much committed in this meeting also that they're going to do it, and now the market has the data. So it's pretty much going to happen. So why would people not take action, in that direction? So that's the next point. You're going to get a rate cut. You have a slowing economy, but is it really an outright recession? Is it a 2008-like scenario? Now, if you look at data points across the market, which is not just, the unemployment data or the employment non-farm payrolls report, just a week back, you had positive GDP prints. And this week, yesterday, you actually ended up getting an ISM report which saw a rebound from the extremely low, I think 48 something to 51 something. And what that really shows you that, we are probably at the point of worst case scenario. Not all data points are down to recession. There are a couple of them which are pointing that way, and which is what people are looking at. People are still waiting for the yield curve inversion theory to play out, and I'll explain to you why that is not going to play out the way as expected, or why I think it will not play out as expected. But first, the US data, because it's extremely mixed in terms of GDP growth, in terms of the ISM, and then you have the unemployment data. You still have some earnings growth cycles happening. So many different things moving in different directions, and based on what you look at, you can end up having a completely different view on what is going on. But here's my thought. Even between 2008 and 2020, you had many mid-cycle slowdowns in which the ISM actually dropped below 50 and then recovered again. And if you see that around this range, 46, 48 is around the range where it bottoms out and then turns up again. So that mid-cycle slowdown is not always a recession, but it is a cause for a good correction in markets. And we have actually, because of the recent selling and the yen carry trade, got a decent correction now in the markets. So every time you've seen this, there has been an eventual turnaround. And if, you are heading towards an interest rate cut, that further will add to the idea. And the risk of inflation, essentially, I think the only item which is still, hanging on the neck has been around the housing, and especially rents, right? Rent inflation in housing, which has really been sticky. Everything else has come off. If you actually look at the commodity cycle, all commodity prices that were elevated are now consolidated for the last 1 to 2 years. Oil, which had gone above all the way to 135, is back to, sub 80 levels, almost knocking at the doors of going sub 70 to the 60 level. And so when we are in this kind of a scenario, oil based inflation, which is one of our major components sometimes, is actually on a back foot, right? We're not getting oil inflation. So what we are really looking at is only, like I said, the only component which is knocking around on the core PC is that related to housing. I don't know how that unwinds, but we are slowly seeing the downticks even if things remain constant. Inflation is a Y-on-Y data point, year-on-year data point. And if you keep the numbers at the same place, if you just don't raise prices for a while, your inflation print eventually goes to zero. So I think that is what is going on. And that is why it's slowly coming off. And moment it speeds on the way to zero, that gives even greater opportunity for the Fed to start doing its rate cutting cycle. Now, does that mean when they start cutting rates, everything reflates again and you get an inflation problem again? The answer is yes. The thing is that will take time to happen. It doesn't happen in one day. If they move slowly on rates, which is what I think they will do, 25 basis points at a time, I don't think they're going to be in a rush to cut 50 or 75, because they don't want it to reflate too fast. They want the inflation problem to come back, but not in a big way. Inflation is good and is needed to reduce the debt to GDP numbers over time. But you want a constrained and limited inflation problem. You don't want an outright big one. So, and if it takes 2-3 years, then that's a long headway that you actually get for a bull run to resume and continue. And that's, I think, what the setting they're really trying to do is slow things down sufficiently that they can speed it up at a slow pace, a pace that they can handle, and not at a supercharged pace that we were going at because of all the post-pandemic spending. So that's the short of it. If they're able to pull it off, things are going to look good. If they fail to pull this off, then of course you have a problem. So far, nothing has happened to point that they failed to pull it off. In fact, the Fed can take a lot of credit for what they've done through the pandemic, in the post period, and in the inflation war. Despite all the criticism, a lot has worked out in their favor. And all the criticism only goes to the extent of saying, oh, they will fail at this or fail at that. But in the end, they've sort of managed the entire scenario. So if they continue to manage it, and that's the optimistic outlook you have to take, then we'll actually get out of this without much trouble. And possibly, like I said, if you've seen capitulation in the VIX and so on, we've already seen the worst case scenario as far as this global rout is concerned. So it brings us back to the bigger picture. And in the bigger picture, if you're looking at falling US yields, you're looking at a weaker dollar in the very, very months to come. The short-term spikes, in fact, have happened in emerging market currencies like Brazil, even India. The currency has been weakening. In India, it's not at a rapid pace. In Brazil, the speed was a little more, but Brazilian real has not really fallen below the lows it had seen in 2018, 19, 20. But it is getting close to that point. And so in that sense, recently, despite the dollar index weakening, we have seen other currencies lose ground against the dollar, and many of them are the emerging market ones, including India. Now, that definitely means it's been some pressure point in the background that is causing it. In Brazil, there's some geopolitical angle. In India, I actually don't know what the angle is, because India has been in a sweet spot. It's also been importing its oil from Russia. So what really is keeping the rupee weak when our reserves are actually growing? Is it the RBI itself, or is it just a currency adjustment because of the various other currency pairs doing different things, including the yen? So yen was a major play there, because you did have a yen weakening against the dollar. The strengthening currencies were only the British pound and the euro. So you had two advanced country currencies that were strengthening against the dollar, but everything else was actually weakening. In fact, the Chinese yuan also was knocking on the days of weakening, and actually heard a theory yesterday that possibly all this, what Japan has really done is to create room for the Fed to cut rates, because now that this panic selling and unwind of excess has happened, it not only has strengthened the yen, but it's put a bid against US bonds. Very interesting things that have happened. And if you have not been watching, I was talking about China. The Chinese yuan, which was also weakening, but not very sharply. And what the Chinese government would have been worried about is that if they cut rates or stimulate too hard, the yuan goes out of control, right? It starts losing significant ground against the dollar, which is also something that nobody wants. Now the USD CNY has actually been falling, because of the weak dollar environment, and specifically after the yen unwind. So the yuan seems more closely linked to the yen. And as the USD JPY heads lower, the USD CNY is also heading lower. And that actually gives a lot of headway for China to start stimulating, right? Because the Chinese market has been under a lot of pressure, and you're not really seeing the Chinese economy pick up, or, its own markets have been, under pressure for quite a while after the initial bump up it got on the last stimulus. And there's a probably felt strong need for China to intervene on this trade. And I think we've just created room for that. So the move by the Japanese central bank has created room, one, for China to stimulate, two, for Japan, for US to stimulate. And that's very, very interesting, right? That was the one pressure point. The weakening yen was actually a pressure point for the others, even though it may have been positive for Japanese markets. And so this whole unwind of the yen carry trade, which we are seeing and we are thinking it's the end of the world, is actually a setup for things to get much, much better from here, because it now allows other central banks to move in a direction with less fear. So the dollar index, and that's the main thing, we come back to the dollar, which really has an impact on the rest of the world, because we know a weak dollar is good for emerging markets and so on, but the dollar index was really not able to fall despite bond yields coming off a bit, and they were not coming off so sharply. The dollar index was really not sliding through. Now we have one last support at 102.1, because I've marked this entire pattern as a triangle or a diamond over the last 1 year in the DXY, where it's been gyrating between 100 and 106.7 on the upside. That range is narrowing, and the bottom end of that range is now 102.1. Once we break below that, we are clearly set up on the downside. I do think wave wise, based on the Elliott wave patterns, the trend is already down, but it will get more and more recognized now that we are in a weak dollar environment, and that will sort of trigger the entire flows, because once US cuts rates and there's more liquidity in the world, where is that liquidity really going to go to? And it's going to go to places outside the US, is what I'm really sensing, as the US US will also get it because US, of course, is at the bottom end of its growth cycle. But as it picks up slowly and, they get things moving, you have an election coming up, I think other parts of the world will become more attractive, which means emerging market currencies, the commodity cycle needs to pick up again. All of that is waiting on the sidelines because you've seen a 80% retracement in copper prices. You've seen oil struggle for months and months. And we will eventually see a pickup in all of that once global demand picks up, which is why you need emerging markets to start doing well. A lot of emerging markets have actually underperformed the US significantly. I think India has been the only outlier among many. Otherwise, if you look across Asia, you will find that most Asian markets were struggling for the last year or two. They did start picking up in the last several months, but it's not been a strong rally. It's been a lot of pullbacks along the way because many of these economies post-pandemic have really not managed to pick up. And I think maybe they're also interlinked with China to some extent. Until China picks up, they're not really getting the lead. So even if you look at the emerging markets index, EEM, the MSCI Emerging Market Index, it's really not gone back to the highs of 2020. In fact, it's not even retraced 50% or 60% of that fall, even though India and US are at all-time highs. So we are unique markets, but most of the emerging world has been struggling, and that is why I think you needed a setup, you needed an environment in which the weak dollar actually benefits many of those, and I think that environment has been set. Now we have to watch out for the actual development, which means now that we've actually done with the panic, it's created an environment to constructively look at financial markets again. I think my sense is the US is probably bottomed. The panic selling is over. It doesn't mean you get a V-shaped recovery because fears around recession and all will play on the mind also after a lot of margin unwind. Adding back to positions is not easy, and so it could be a slow move on the way up, but I do think the worst is probably over because none of it is based on us going into a deep recession or going into a financial contagion. Those environments don't exist. We do have a weakening cycle economically, and that makes sense, and that is why the rise might be slower. And similarly in India, there are concerns around valuations. But those concerns around certain sectors, certain segments. At the same time, if you actually search around, you can find rooms of undervaluation and growth in the market, which is why money can simply rotate into and out of things. What it can impact is the overall index gains, right? What percentage returns can you have at an index level unless your overall earnings growth trajectory really picks up from here. So that is something to watch out for. But stock selection does become then critical for generating those outsized gains. But in terms of purely Nifty, even if you slow down the speed on the way up, it still remains a by the dip kind of index environment because we are still outperforming, at least till yesterday, most of the world. We'll see what really happens today. Some of my short-term indicators, I've spoken about the swing early on in this podcast. If you actually look at it, and I'll give you numbers, we are down to 3 on Monday. Okay, and we use a swing and an average swing. The average swing also dropped to 11, 12 yesterday. So both of them actually getting oversold simultaneously does tell us that we have a short-term low in place. The question next is, how much are we going to pick up from here? I think there could be a meaningful pickup because, like I said, we have outperformed the rest of the world, and we might continue to do that. We can slow down the pace of this rally. Okay, we can move up in small steps, but we may not really change direction very, very quickly. I think the only headwind ahead is probably the US elections, and that usually brings some pressure on US markets sometime between late September, October. That will definitely happen. But in the meantime, most markets have become extremely oversold and probably bottomed out. And this was your fire sale buying opportunity across markets, across stocks, because a lot of stocks, even in India, have actually corrected even while the Nifty has held up better on the back of certain sectors like FMCG, pharma that have been going up. So the index has not corrected that much, but a lot of stocks have actually corrected in the background, and that is why this dip might have been the final fire sale in terms of the near-term correction post-election, and we may be set up for the next rally. That is what I think we've done here, and that is what I look forward to in the coming weeks. Slow build up. It may be fast, it may be slow. I'm not taking a speed bet over here, but I am taking a directional view that the worst is over.